Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Are your technical levels being manipulated? Are you using hard stops? If you're a retail trader and you believe you have an advantage or knowledge, are you swimming with the sharks and you're the bait? Now, if you must use hard stops because you're too busy to watch the markets all day long, there's a couple rules after you manage position sizing. First, put the stop loss a few percent below where the resistance level is, where you think the stop should be. And always use odd numbers between nickel increments. At Revere, we don't use hard stops, but rather alerts depending on the price and volume. Then we make a decision as to what to do. Price is truth, no exceptions. And the reason I bring this up is there was a tweet from a guy that said, sent out, and Don sent it to all of us, is AI now hunting your stops? Are the quant funds looking at your technical and Fibonacci levels? Whether it's high frequency trading or whether it's AI, it doesn't matter. The big hedge funds and quant funds, they know. So do the sell side. They know where the stops are. That's why you got to be very careful with your stops. Otherwise, you're going to get, well, I was going to use a word, but you're going to get screwed. All right, now, first I'm going to go to a mailbag. Two comments from this. It is a long-time client, MB, and he sent this one on X 2 days ago. With the NASDAQ down 2.5% and the S&P down 1.3 as of now today, this is intraday, I'm thankful for my Grotection account being down only 1. Thanks for limiting my losses. Don's comment. Thanks for recognizing what we do. Now, he emailed this yesterday, or actually on 7/21, he said, it's a confusing stock market. So that is why I have Revere Asset Management on my side. They eliminate the fear and greed. Steel nerves and a strict rules-based approach is what it takes to succeed. So how are you doing? Because right now this is a bifurcated market and some growth stocks are holding up while a lot are getting just absolutely slaughtered. So I ask you, what's in your portfolio? Now, when you listen to these guys, do they sound like you, and do you do this deeper research or your advisor? And with that, I'm going to turn it over to Don. Don?
Yeah, thanks, Dan. That is a very key point, and we talk about it in-house all the time about the comment you made about algorithms and stop levels. And, a good example today is looking at the NASDAQ 100. The lows of back here in 6.9 and then 7.17 made a very obvious level for people to put stops. So no doubt people came into today and say, well, I'm just going to put my stop at 686.36. If it breaks below that, I'm out. But look exactly what happened on the NASDAQ 100 today, undercutting that level and getting back into the trading range. This is a classic example of breaking down. And this is not where you want to put a short. You want to short on a wedge up into a declining moving average. We don't like to short breakdowns because, for one thing, if you shorted the breakdown today at that level, it's the third day down. Third day of any trend is a lower likelihood of success, whether that's to the upside or the downside. Something we talk in and on our videos and in-house all the time. Well, it looks good. It does look good, but this is the third day up and it's gapping up. How much realistically higher do you need to go, or do you expect before there's some sort of sideways or pullback action? And that's not to say it's foolproof. Nothing is foolproof in the market, but we're trying to put the odds in our favor. So this NASDAQ 100 chart forming not a bad looking consolidation, but it is below the now declining 50-day moving average. That's the red line that's highlighted. It's below the declining 21-day moving average, which broke below the 50-day moving average. So those are two things in the negative column, quite obviously. Compare that to the S&P 500, much stronger on a relative basis, nowhere near those lows of 72.37. In fact, still 3% above. And this is indicative of what you're seeing in the tech/AI trade, where a lot of those names have gotten completely blasted. Some of them are bouncing, but a lot of them are bouncing just right into levels that you could consider as a shorting level. Here's Micron, had a 4-day bounce, got back above the 50 and the 21. Well, if you chase that, you're down 5% today as it's breaking below, back below the 21 and the 50-day moving average. And chasing strength, especially in this market, has not been rewarded in these tech names. There's times when you could chase strength, and it's when something is in a strong uptrend, but that's not the case anymore. A lot of these stocks topped in late June and are having a tough July. Also, we're going to talk about the Revere 100 and some of the names that have reported earnings this week and how we treat them when we go to the individual segments. And then Ted's going to have a nice talk about VWAP and Fibonacci levels on some of the individual indexes. But what is our plan right now? Well, the S&P 500 was in a 15-day range. Let me go to a 60-minute chart here. And it's pretty clear that this 74.20 level was acting back on 6/29 and the beginning of July. That was the bottom of the range. The top of the range was 75.80. We got up to that level twice. We also got to that level back at the beginning of June and in the middle of June. And this was just a long trading range that we're in. Yesterday, we broke below that trading range. That caused us to take some of our exposure off on that range break. And it also coincided with a hard break below the 50-day moving average. We had two closes below it the prior week and earlier this week, rallied, wedged back up above it, broke through it again and that level on Thursday. And now there's some rumblings about China getting involved in peace talks with Pakistan for the U.S. and Iraq. And we're seeing a bounce today back inside that 74.20 level. So if you go back to that key level, that's really the level that we're keeping an eye on as it's the bottom of the range. Get back in it, good. That means that you've got a level to trade against. And again, it's a breakdown level that would have faded this 74.20-ish level. And it also held, I'm highlighting the 65-day exponential moving average, which is an overshoot level from the 50-day moving average that we keep an eye on in-house as well. And really glad that Market Surge expanded their ability to put more moving averages on charts, because they do come up from time to time, and you'll see that they're valid and they're professionally used moving averages. The 65 is, some people use the 63, some the 65. The feeling is it's basically a 3-month moving average, whereas the 21 is a 1 month. And the 50 is just a kind of a standard, an industry standard recognized level. And yes, the algos are aware of them. We've said that for a while. That tweet that you referenced, it's confirmation bias, but it's something that we already knew, and it's something that we're tuned into. So that's really the level that we're looking, that 74.20. Can we get back above it? Can we hold it? How do we end up closing? That's really going to be critical. Now, back over to how we're doing in the portfolios when we're really down to just holding 4 names right now. We've been stopped on everything, and we've reduced our exposure, not only on stocks, but on the indexes as well. But the things that we still have small positions in are holding up pretty well. Dell is held in Grotection, HPE, sister company held in Grotection, forming a very nice tight pattern here right below that 50 level. And we also own Lilly in Grotection. This has been a non-tech leader that's held up very well, is making a higher high today. We're also still involved in Datadog in Turbotection, which is holding the 50-day moving average and forming a pretty nice cup and handle there, and AMD as well. Also holding up very nicely, undercut and held the 21-day moving average today. Nice tight action. So there are the Revere 100, which we talk about in some of our videos, and we're going to talk about some of the names that have reported, as I said, positive and negative reactions. But we're isolating the ones that are showing relative strength, holding up, not ones that have these low teen ATR daily patterns that are just asking to get shaken out. But here's a good example of the third day. Here's AMD pulled back hard on the third day, which was the 17th. That was last Friday, put in a hammer candle. Then it went 3 days up. If you chased it, now you're looking at the second day pullback. But this is a very good low risk entry on that because, for one, you're not chasing because it rested for 2 days. It undercut a key level, the 21-day moving average, and it's rallying. And there's a key level right below that, the 50-day moving average. That should also provide some support. So,
and the 21
not a lot.
Hooking up. The 21, the short-term moving average, is actually turning up, hooking up.
The 20, yes, correct. The 21-day is it rolled over and then now is hooking back up, and we'd like to see that too, certainly. So that's where we are in the portfolios. That's where we are on the overall individual names. The NASDAQ 100. Let's take a look at the equal weight S&P 500, and this is outperforming today as it had one close below the 21 and got right back above it. This has been showing subtle relative strength because money is flowing out of these growth sectors and into value sectors. Let's take a look at SPYV. This is the value half of the S&P 500. You can see it's choppy, but you can see higher highs and higher lows being made in the relative strength line. Compare that to SPYG, the growth half, which is on a relative basis making lower highs and lower lows. So this is a somewhat healthy rotation. I say somewhat because you don't like to see the leaders get blasted the way that they did, but you get what the market gives you. You don't always get the market that you want, quite obviously. And let's look at IWM small caps bouncing off the 50-day moving average as well. They've been showing some relative weakness over the last month or so. Ted made a very good point about oil. Here's USO. Oil with the Iran conflict having a strong run this week, and also the 10-year and the long bond yields broke out yesterday. Now they're pulling back today, both yields and oil, on this headline. And if that leaves this island at the top, that would be bullish for the market. We're always trying to put things into the positive column and the negative column. Yields have been in the negative column. If this puts in a top, and if oil tops, that's going to help the economy and certainly help the overall market. So always keeping an open mind, understanding the inter-asset correlation. We talk about it in the tail of the tape and in our videos every night. These things are important, and taking it day by day. It's been a tough, choppy market with the constant headlines, and then add into that rising interest rates, a new Fed head, a lot going on. But our core position in the S&P 500 has held up certainly well compared to growth names. And we've got levels to trade against. We've got levels that are bearish and are bullish. And Ted's going to dive into that a little bit deeper when he does his presentation. But so let's review some earnings now. Let's take it over to the guys. And Connor's going to start off with a couple of key AI names that reported earnings, and he's going to talk about the reaction to that earnings. And we're going to start off with AEHR. Connor, take it away.
Yep, thanks, Don. So, we're getting back into the swing of things in earnings season, and so far it has been, I would say uninspiring. The reactions haven't been as strong as we saw, say, as we were coming off the bottom in April. So AHR is the first one, and you can see that ugly bar that it had. And that's because it initially gapped up 28% on earnings, and the earnings were great. They had a strong Q4. They improved their outlook, and they received 8 million in new orders for silicon carbide. And they also had record quarterly bookings of 60 million and backlog of 80 million. So when you looked at the numbers, it looked good. It was gapping up 28%, right? That was pretty bullish. And although this base has been very, very choppy, when you zoom out, this stock had a monstrous move from 40 to triple digits, and the market got weak, and it has a high ATR. So these big 40, 50% swings are just kind of the normal for a stock of this nature. So, despite the volatility, it was building out a decent base, but the reaction was not what you want to see. A gap, you would rather have a gap down reversal and close green versus gap up and fade. And again, what is that telling you? That's essentially telling you that the market kind of already priced it in. Despite the good numbers, why can't the stock go higher? So that had a really ugly close, and now it's back into the low end of the base. And another thing is, in a weak market, these earnings gaps, have a lower probability of working just because of the market. And so now, this one is back in the low end of the range, and we're aware of the good earnings that it reported. We're aware of that reversal, but maybe this is just going to be a delayed reaction. It builds out in this base while the market chops around a little bit more and then provides a setup. So we're not taking this off our radar, but, uninspiring action on earnings for sure, over 100, all the way down to, $80 for now. So this is a good one to monitor in the coming weeks as it builds out this base, although extremely volatile stock. And then the next one is GEV. And this one also, has had a pretty big run the past couple years, and the story has become more and more known. And again, this one, they did have good earnings. Their Q2 EPS missed expectations, but the broader print showed strong demand, cash generation. Their data center orders over 5 billion year to date, more than double of 2025. So when you just looked at the headline, it looked pretty good. The only thing was the main weak spot was wind. Revenues fell 10%. And again, this one initially tried to gap up and then faded the whole day, closed the day red, and it just looks like the stock is, in a big choppy base, but it continues to make lower highs. So, the bottom line is good earnings, good stock, not good price action. And it just continues to be choppy. So that's GEV. And then last one, Intel, which was last night. And this one, following the same theme, gap up and fade. Intel last night gapped up to $113 a share in the after hours, and they had a Q2 beat, strong Q3 outlook, seeing healthy demand. The numbers look good, but stock was unable to go higher, and this is even after it's pulled back from 150s all the way down to sub 100, and this it gapped up, hit 113. Everyone was like, semi trades are back on, and then it now it's red right now, down 2%. And that's really the story of the earnings season so far. A lot of gap ups and fades, and that just tells you one, it's maybe that it's already priced in. Some of these stocks have made big moves, or number two is that we're just in a weak market backdrop, and if you don't have the market behind your back, it's going to be very hard to to hold up an earnings gap, especially if people have higher cost basis, they see that gap up, they just want to get out, and that kind of creates a lot of supply. So really the bottom line for all these stocks are the numbers, catalyst, story, sales, fundamentals, future projections. All that is very important. That is what gives you better odds to catch a good earnings gap. But at the end of the day, the only thing that matters is the price action. And no matter how good the numbers are, if the stock, can't go up, goes red, then that's telling you everything you need to know, despite, not the earnings call. So it's going to be interesting. Earnings are picking back up quite a bit now moving forward. So see if this trend changes. But these are 3 examples, and I think Jackson's going to talk about some more that are following suit as well, weak reactions.
Good stuff, Connor. One more that I want to chime in on that is holding up pretty well is ASML, key chip manufacturer. And, great numbers, of course, beat and raise, just kind of going sideways, but not breaking down. What I like to do when we get earnings reactions like that is set alerts at the high and the low. That'll tell you if it's breaking down out of the range from the earnings day or if it's going to break higher. In this case, we've seen both a break higher and a breakdown. But again, that's giving you information, and that's what this is all about. The market is a incomplete information. We try to put the pieces together as much as we can, but the reaction to the overall earnings report is what's important. And speaking of reactions, they're very often negative to earnings. Let's go over to Jackson, and he's going to start off with a couple that, despite some great numbers, sometimes not great numbers, but it's the reaction that counts, and not the earnings report, not the numbers reported. It's looking ahead and interpreting what's happening. And let's start off with Google. Take it away, Jackson.
Yeah, absolutely. Thank you, Don. Excited to be here today. Looking at Google, so like Don said, we had another instance of a double beat and raise, and then combined with a raise, an increase to the CapEx guidance, which kind of affects the entire AI ecosystem. And in this case, even on that seemingly positive news, price is truth, like as Dan likes to say, and Google gapped down and is breaking the 200-day really for the first time since the runoff of the lows in April of 2025. And so, Don, if another thing that I wanted to point out is that rejection at the 50-day. That was a big key tell. The rounded 50-day got rejected twice and then failed lower into the 200-day / 40-week. But Don, if you don't mind pulling up the weekly chart real quick, I just want to highlight how this is really the first definitive touch of the 40-week moving average since that low. And as far as the Mag 7 names are concerned, Google has largely been the leader during this entire cycle. So having this name showing such significant weakness on another positive report just goes to show the changing character and the way that the market is now reacting to seemingly positive news. Awesome. Moving on to Tesla. So Oof. Tesla was actually a single beat on revenues, missed on earnings. And what we have here is another giant gap down in one of the Mag 7 names, and kind of dropping to the downside out of what was looking to be a tight range on the weekly chart. And so we really don't like to see that weakness. And another thing that Don's kind of highlighting there on the intraday, right? We got the gap down, go down, which just goes to show the significant weakness after the report. Generally, if there's an overreaction, you will see some form of strength after the gap down, and we haven't seen that with price falling through to the downside. And Don, if you don't mind pulling up the weekly or the monthly, one thing I wanted to point out here in Tesla, very similar to Google, we're now breaking the long-term rising bottoms line from the January 2023 low for the first time since we put in that low. And so this is really just all risk off as far as Tesla is concerned, and recognizing that this sort of damage is going to take a while to play through. Also, moving on to STM. another name within the uh, semiconductor theme. This had been one that was shaping up quite well actually a few weeks ago, and showing significant RS versus some of its counterparts. I know we bought it in Grow one time, and then also tried it in our personal sets as well. And looking at this name, we had what was kind of a green line breakout into a fresh stage two O'Neill base, and then ultimately just couldn't hold at the 50-day. Kind of tried to bounce below the 65-day, and then had a report that was positive for this quarter, but heavily reliant on continued acceleration into Q4, and that the market doesn't seem to like what they put out regarding guidance. So just another tape bomb, big gap down below the 100-day moving average there, and falling through to the downside. And another thing to point out on earnings report was the massive volume there. That's a big negative from a technical standpoint. So yeah, just quite the character shift and qualitative shift in the first round of earnings here, as you've seen between the 6 or 7 names we've looked at during Connor and I's segments. So passing it back to you, Don.
Yeah, let's take a look at one more that was holding up extremely well as little as a couple of weeks ago, and put up earnings. Look at the earnings growth on this. This is MXL Max Linear, 650%, 1,650% earnings growth. Down today, 19%. And this is another one where we own this. We got stopped out on it, and it made a 4-day bounce, just enough to make people start thinking about wanting to get back into it. Met with an earnings report that just blasted lower, just not working. And if it's not working, you can't do more of what's working and do less of what's not, is a pretty simple way to approach the market. But very important to know. One other thing about Google I want to go back to. One of the reasons that it was negatively perceived is they are spending so much in CapEx, which benefits a lot of the other AI infrastructure players, but they're spending so much that they are now cash flow negative. And when you're cash flow negative is not a way to run a company long term, but they're basically going all in on AI, understanding that if they fall behind, it's survival of the fittest. And they've got a massive niche, but with AI out there, they need to stay on the top of where people go when they want information. And you got to spend money to keep up there. But the hyperscalers, and they're one of them, the market is starting to frown on all that money that's being spent, and them going cash flow negative was a pretty big news headline. Great stuff, Jackson. Let's turn the controls over to Ted, and he's going to bring up Deep View and talk about some of the tools that he uses within Deep View, and show us what you got, Ted.
Thank you, Don. So at Revere, we typically primarily gravitate towards moving averages. But for this segment, I turned off all the moving averages to give you guys a different perspective. We don't use Anchored VWAPs that often, but there are certain use cases. I mean, they are really useful, and perhaps we should use them a little more sometimes. But pretty much what an Anchored VWAP is, everyone is probably familiar with the regular VWAP. But Brian Shannon, he's quite well-known person in the technical analysis world, and he developed Anchored VWAPs, which is pretty much an average of price as well as volume combined into an indicator that just shows whether buyers and sellers are in control. And with the Anchor VWAP, it becomes flexible where you can anchor it to any single day, week, or just depending on what time frame you're on. So this is the chart of the S&P 500. I have 2 Anchor VWAPs drawn. One is from the Iran correction low, and then the second one is from the Trump ceasefire announcement. And with Anchor VWAPs, you don't want to arbitrarily just set the Anchor VWAP to any single day. You want to pick major lows, major highs, major catalyst days. So then again, it could also be used for earnings gaps too. But for the sake of the index, we used it for this follow through day here. on the catalyst, and then the major low that we put in just a few months ago. And what you see is these lines that are drawn on the chart, it's indicative of whether buyers or sellers are in control. And you can see with the S&P 500, the previous two pullbacks were contained between the Anchored VWAP from the gap day, from the Trump ceasefire, as well as the Iran correction low. So those are two really key levels that we're watching for. John already talked about the 74.20 level, which we are holding now. But there's two below, two major ones that are showing that right now buyers are still in control from the gap up day and from the correction low day. So that is definitely a good sign. Two key levels we're watching, which is about 73.50 and the whole number 300. If this pullback or short-term correction were to continue further, another layer of analysis we occasionally use are fib retracements, which just give us some levels to potentially look for support. And you can see the first fib retracement, which is a 23.6% one, also coincides with these Anchored VWAPs, which has contained the pullback so far in the S&P 500. And if we were to continue further, we would look at the next 38 one and then perhaps 50, which is sometimes normal in a huge move. But right now, the support levels here at the 23.6% fib and the two Anchored VWAPs are containing it so far. So that is definitely really constructive. In the NASDAQ, similarly, just a couple levels as well, anchored at the gap day from Trump ceasefire, as well as the Iran correction lows. You can see right now, the NASDAQ is relatively weaker than the S&P 500. We broke the Anchored VWAP from the gap day, but we did hold really today. The low of today was right at the Anchored VWAP, extending back to the Iran war correction lows. And it's really no coincidence that we are finding support here. This is really one of the last lines in the sand since this move that shows whether buyers or sellers are in control. So as of now, buyers have stepped up today. They defended this level, which is about 685. And that also coincides with this key low here of the base, which is June 9th's low. So that's another very key level we're watching for. The next step for this index is to close today strong, holding that 685 area, and then reclaiming the 700 whole number area, which was one of our keys this week. And also, again, it coincides pretty much with this Anchored VWAP as well. Let's say the correction does pull back further. What areas could we potentially look for support? I'm going to turn on the moving averages again because there's a lot of confluence. When you have confluence in various technical analysis methods, you can gain greater confidence that that level could be defended either by sellers or buyers. But in this case, if we do correct further, this is getting a little messy, which is why we don't like to use so many at once. It just destroys your charts and there's too much going on. But anyways, if we do correct further, you have the 100-day moving average here in teal, which also coincides with 38.2% fib level. And then if it gets even worse, you have the 50% fib level, which means you pull back, you retraced 50% of the current move from the lows to the high. That 150-day moving average is there as well. And that also coincides with around the breakout level of 640. So those are just some key levels we're watching for based off fib retracements and Anchored VWAPs, aside from our moving average analysis. So just wanted to share those. We don't really talk about these that often, but here it is quite relevant.
More tools in the toolbox. Thanks, Ted. Dan, that's it from the tech side. You can
thank
take
you,
us on
Don.
home.
And the bottom line, folks, for the retail people that don't quite get this, they're not traders. VWAP means volume weighted average price. So it takes kind of a combination of both volume and price, right? The other thing Don was showing when he showed the NASDAQ is the 21 exponential moving average is breaking below the 50-day. That means short-term momentum in the NASDAQ is weak. That means you got to be very selective or move to value or do something. And it's going to be key on two things. The last thing he had a chart of interest rates, and it looked bullish because it was going up. That means bond prices are going down. They move opposite. So interest rates and oil are going to be key. But the bottom line is what's in your portfolio, and does your advisor or do you sound like these guys? Listen, if you like what you heard, please tell a friend, tell a neighbor. Just go to revereasset.com. Up in the right-hand corner, there's a subscribe button, and this will come to you Saturday morning. However, if you go to YouTube and just type in Revere Asset, search for and hit subscribe, Zach, our producer, will have this out probably by 12:30 or 1 Central Time, so you can actually use it and take some action. On our website, there's a Contact Us button if you want to reach out and want a complimentary portfolio review or simply want to become a client or have questions that you want discussed on air. And you can always call us old school at 855-REAL-WEALTH. We'll talk to you next week on Your Money, not Wall Street's money, your money.
Because it's not about how much you make in the markets, it's about how much you can keep.